Decoding market dynamics, the intricate dance of behavioral psychology in understanding market trends and investor sentiment. Introduction. Within the labyrinth of financial markets, where algorithms and economic theories intersect, there exists a powerful force that often defies conventional logic: the human mind. Behavioral psychology, a discipline that explores the cognitive and emotional factors influencing decision-making, plays a pivotal role in shaping market trends and investor sentiment. This exploration delves into the nuanced interplay between psychology and finance, unraveling the mysteries of why markets behave the way they do. The psychological underpinnings of market trends. At the heart of market trends lies the collective behavior of millions of individual investors, each influenced by a myriad of psychological factors. Behavioral psychology recognizes that investors are not always rational actors driven solely by economic considerations. Emotions such as fear, greed, and overconfidence can distort decision-making, creating waves of sentiment that cascade through financial markets. Consider the phenomenon of herd behavior, a classic illustration of how psychological impulses can drive market trends. When investors observe others making certain investment choices, there is a tendency to follow suit, creating momentum that propels a particular stock or asset class in a specific direction. This psychological contagion can lead to market bubbles, where prices detach from underlying fundamentals, fueled more by the fear of missing out, FOMO, than by rational analysis. The role of cognitive biases. Cognitive biases, ingrained patterns of thought that deviate from rational judgment, exert a profound impact on market trends. Anchoring bias, for instance, occurs when investors fixate on a specific reference point, often the price at which they bought a stock. This fixation can influence their decision-making, preventing them from reacting objectively to new information and contributing to the persistence of trends. Loss aversion, another cognitive bias, can also steer market dynamics. Investors tend to feel the pain of losses more acutely than the pleasure of gains, leading to risk-averse behavior. In a market context, this bias can contribute to sudden sell-offs during periods of uncertainty as investors seek to avoid further losses. Even if the underlying fundamentals of their investments remain sound. Emotional rollercoaster of investor sentiment. Investor sentiment, the collective mood and attitude of market participants, is a barometer that reflects the emotional rollercoaster inherent in financial markets. Behavioral psychology sheds light on how sentiment swings between extremes of optimism and pessimism, driving market trends and influencing asset prices. During periods of exuberance, investors may exhibit overconfidence, believing that current trends will persist indefinitely. This optimism can inflate asset prices beyond their intrinsic value, setting the stage for corrections when reality diverges from expectations. Conversely, in times of panic, fear grips the market, leading to indiscriminate selling and creating opportunities for value investors to capitalize on mispriced assets. The impact of news and social media. In the digital age, the dissemination of information and the amplification of investor sentiment have been magnified through news outlets and social media platforms. Behavioral psychology acknowledges the role of these external stimuli in shaping market trends. News headlines, whether accurate or sensationalized, can evoke emotional responses, influencing investor decisions and sparking market movements. Consider the impact of a breaking news story on a company's financial health. If the news is positive, it may trigger a surge in buying activity as investors rush to capitalize on the perceived opportunity. Conversely, negative news can lead to panic selling, amplifying market volatility. Social media platforms, with their ability to facilitate rapid information sharing and collective discussion, can further magnify the influence of behavioral factors on market trends. The persistence of patterns. Behavioral psychology recognizes that certain patterns of investor behavior tend to repeat over time, creating recognizable trends and cycles in financial markets. Technical analysts, who study price charts and historical trading volumes, often rely on these patterns to make predictions about future market movements. For example, the concept of support and resistance levels, where asset prices tend to bounce off certain thresholds, can be attributed to the psychological tendencies of investors. When a stock approaches a previous low, support level, investors may perceive it as a buying opportunity, contributing to a bounce back in prices. Conversely, resistance levels may represent points where investors, influenced by past experiences, become hesitant to buy, leading to price reversals. The role of regret aversion. Regret aversion, a psychological phenomenon where individuals seek to avoid the emotional pain of making a wrong decision, can significantly impact investor behavior. This aversion can lead investors to follow the crowd, even if it means deviating from their original investment thesis. Fear of missing out on a profitable trend or avoiding the regret of making a contrarian call can drive market trends, creating self-fulfilling prophecies. Conclusion. In the grand theater of financial markets, where algorithms crunch numbers and economic theories guide policies, the human psyche remains an indomitable force. Behavioral psychology, with its exploration of cognitive biases, emotional responses, and collective behavior, unveils the intricate dance between the mind and the market. Investors who grasp the significance of behavioral factors gain a deeper understanding of market trends and investor sentiment, empowering them to navigate the unpredictable currents of finance with a blend of rational analysis and psychological insight. It is a realm where numbers and narratives converge, and success demands not only an understanding of financial models, but also a keen awareness of the complex interplay of human emotions that define the world of investing.